When will the economy be most vulnerable to this slowdown? And given that we can no longer count on a Fed put, where does that put the markets?
Yeah, thanks, Shery. Good to be with you all again. The economy is weakening gradually for the moment, but there's a buffer that's being worn down. That buffer is liquidity. And as that liquidity gets worn down, probably later this summer and into the fall, we'll start to observe more noticeably signs of weakness. We're already seeing some in housing. We're seeing some softening in the labor market. We're seeing some softening in consumer activity. That's going to get more pronounced as the summer progresses.
And do you get defensive then on those sectors that you mentioned, given that, of course, mortgage rates are soaring, not to mention that things are getting expensive for consumers at the moment?
Absolutely. They are getting expensive here. And, we've been in a quality orientation for some time now. We actually went overweight U.S. versus Europe versus emerging markets some time ago. And what we're doing is gradually rotating more towards defensives and sticking with our quality picks. We still like information technology. We like healthcare. We like energy, partial inflation hedge there. All three of these have pretty good cash flow, good balance sheets, and really good organic revenue streams for the future, we think.
What do you like in terms of energy, and how do you get that exposure?
So, I mean, there's a number of ways to take exposure. We're talking about ordinary equities. We're talking about ETFs. And then, think about a broader commodity exposure beyond equities. Go directly to the commodities. Some people like to do gold or precious metals. We think the broad basket of commodities here is where you want to be, and we would hold a full strategic or long-term allocation to agriculture, base metals, precious metals, and of course, energy.
If you're a long-term investor versus a shorter-term tactical investor, what are the different opportunities that you would be looking for in this market with all the concerns about the shrinkage of liquidity and these recessionary worries as well?
Well, so both have an opportunity here to take advantage of quality, we think. Tactically, yes, check the box, but also a long-term investor, especially if he or she is willing to be a little bit patient. And that's something long-term investors sometimes forget in a market like this, where you're in a bear already. You can be patient. Your objectives are in the future. You want to take the opportunity to incrementally and in a disciplined way put cash to work. And there's a lot of cash here in the U.S. In the accounts, brokerage accounts of clients, or you get long-term bonds that mature. Take that cash, move it into short and intermediate term in investment grade, as well as potentially some of those equity sectors that I mentioned. So be careful here, be patient. You can do it. Same thing for the short-term investor. Be patient here. Focus on quality. Build up the defensives. They've been underweight for a long time in our work, but build them up gradually.
Do you trade Europe at all, given the big rate hikes that we saw across the continent and the potential that might really, actually move them into a recessionary territory for most of those economies? Yeah,
we think there's just too much hair on that European question. The war, energy, we're really concerned about what happens with the natural gas picture. The Russians cut some natural gas exports just this week, claiming technical issues, but there's some question about that. There's some real vulnerability, we think, in Europe going forward. They're much more exposed to a slowing Chinese economy through exports. We've been underweight as much as we could, Europe and Japan, for the last 2 years. It's been one of our better calls.
We've seen bonds kind of starting to gain relevance again in a balanced portfolio. What's your view, particularly when it comes to sovereigns?
Sovereigns, we excluded sovereigns on a strategic basis a few years ago, international sovereigns, just because the yields have been so low. Yes, the yields are starting to come back a little bit here, but the yield differential still strongly favors the U.S. And with the dollar so strong, the euro looking like it's heading towards parity, and the yen at its weakest in a long time, we think we'll still stick with the U.S. and avoid even a tactical positioning in Europe and sovereigns. We do like
always great to have you with us.
We would have a little bit of emerging market exposure in dollar-denominated debt. Excuse me for interrupting.